Welcome everyone to the latest webinar from Coronis Health. You are tuning in today to M&A Trends in the behavioral health industry, what you need to know to successfully sell your business. We are really excited today to bring a couple of renowned speakers to you, but first let me tell you a little bit more about what you're going to be hearing about. So with all of the recent changes and shifts in healthcare and insurance reimbursements, we have heard a lot of facility and behavioral health, business owners contemplating selling their business. So we wanted to put together this webinar where some of the real industry experts will dive into the latest M&A trends and help equip you with some essential knowledge to navigate this big decision. So we'll explore some of the challenges that could be faced by facilities in the behavioral health industry, the shifting dynamics that are happening, and hopefully you will also gain some valuable insights into some key factors that could influence your M&A activity and understand how to position yourself in a great place for a successful sale. So with that in mind, let me introduce our speakers. First, we have Kevin Taggart, who is managing partner and co-founder at MERS Taggart. He has, previously founded a land development and home building company where he learned a lot about all aspects of running a business. He's also been co-owner of a home care company, which he sold in 2010. So he has been in those shoes. And since then, he has been guiding other healthcare companies through the sales process all around the country. Second, from MERS Taggart, we have Peter Thiessen, and he is a managing director. He began his healthcare career back in 2004, which sounds like a really long time ago these days. And he did that by acquiring behavioral health facilities for Horizon Health. And since that time, he has been involved in almost 40 transactions, overseeing the acquisition of over 200 locations for companies like Humana, but also for companies like Baymark Health Services, which I'm sure many of you know. So he has been a buyer in this behavioral health space for 10 years. And last, but of course not least, we have Tracy Lamb, who is the president of the Behavioral Health Division at Coronis Health. She joined Coronis in 2016 and has successfully overseen the Coronis client base to over 70 accounts. She has over 30 years of experience managing large teams ranging from Fortune 700 to small privately held organizations and deep subject matter expertise in the behavioral health space. So without further ado, let's get started. And as a reminder, any questions you may have, pop in the Q&A.
Thank you, Arisa. I just wanted to start with a quick agenda and let you know we think we're going to speak for about 20 minutes and have a little Q&A. Might go a little longer. We're kind of fluid with that, just to give you a timeline. Again, it's recorded so we can share with you if you're not able to stay on for the full time period. We're going to first start with Kevin, who's going to speak about the current landscape, share with you a Q1 report that they put together quarterly. Then we'll get into the perspective from a buyer's perspective, and we'll hear from Peter, who sat on the other side of the desk, and give his thoughts there. I will then share what I'm seeing in our landscape from the revenue cycle management perspective and some of the changes we've seen in the past 4 years. And then we'll talk a little bit about, some of the things you need to think about to sell your business, which surrounds itself a lot with reporting. So with that, I will give Kevin the floor.
All right. Thanks, Tracy. I appreciate that. Well, so you can also see the full report on our website. These are just some of the graphs, and I was going to really kind of talk to them, but the full report's on our website if you're interested in reading it and you didn't get it. But if you look at the trends over the last several years, Q1 of 2023 was really the lowest number of transactions since really the pandemic started. Q2 of 2020, when really COVID was kind of taking effect and everybody put a pause on things for a couple months. The last 2 years have been really gangbusters in the behavioral health space. But I think the the biggest thing that I don't think people realize that don't do this every day is, the rates going up for the buyers to acquire businesses and the private equity groups. We generally deal with institutional investors, private equity groups, family offices, or companies that are owned by them, sometimes public companies, but there's not a ton of those in the space, as you all are probably aware. So the rates going up have really affected, I think, the transactions over the last Q1 specifically. The rates started going up last year, and so I've seen balance sheets of large strategic buyers that, all of a sudden in 2021, they were paying, call it $20 million in interest payments. And now they're at about $40 million in interest payments. So it's very material to their cash flow and their ability to purchase other companies. So, and then I also think that, kind of throw in a little fuel in the fire. The three largest bank failures in U.S. history happened this year, and so over the last couple months, and so that's also spooked people a little bit. That didn't really happen till March, so but that put some things on pause. We Silicon Valley Bank, Signature Bank, and Silvergate, for those that aren't aware of what banks failed, were taken over by the FDIC. It was really a big deal. We actually sold a company on the Monday before Silicon Valley Bank failed, and Silicon Valley Bank was actually the lender. So if that deal was scheduled for a week later, it wouldn't have happened, at least not with them, and it would have pushed the deal back several months at a minimum. And so when that happened, the FDIC only guarantees $250,000 per account, and so most people that are buying companies and run companies have a lot more money. I think there was about $150 million in unsecured funds in Silicon Valley Bank. So the government stepped in on a Sunday and really calmed things down. I think if they didn't step in, it would have been much worse. So I think the FDIC did a really good job starting to calm things down. Things seem to be getting back to normal, but I think that was a big deal for a lot of lenders out there. And so it's gotten much more difficult for buyers to get the funds to acquire these companies. So that's, and I think some of it too is, the last couple of years have been, really strong for the market in behavioral health for a couple of reasons. So I think it's somewhat reverting to the mean. There was the threat of capital gains increase in 2020 and then 2021. So that forced a lot of deals forward. Behavioral health proved to be really pandemic resistant. Most behavioral health companies that we worked with over the pandemic really did well during the pandemic. And you think about historically, dermatology, dentistry, things like that had been considered to be really recession resistant, but they weren't pandemic resistant, much like behavioral health, which were considered necessary services. So I think there was a lot of things that were good tailwinds for the behavioral health industry that have somewhat subsided or kind of reverting back to the mean. So I think that's the, if there's a negative, I don't want to say negative, but those are kind of the challenges. I think on a positive note, I think Q3 and Q4 will still be very strong because deals just that should have happened in Q1, and I'll give a couple examples of that as we go through, are getting pushed to Q2 and Q3. I can tell you personally, we're as busy as we've ever been. I'm somewhat struggling to keep up a little bit at the moment. So I think activity is still very strong, and I think that activity will translate into deals getting done in Q2, Q3, and Q4. More specifically, probably Q3 and Q4. A couple of examples of just activity. We took a $5 million EBITDA ABA company to market a couple months ago, and we had about 160 potential buyers express interest in that. We took a small $1 million EBITDA company to market this week, and there's almost 70 potential buyers interested in that deal. So
Wow.
Buyers are still looking at deals. They're still making offers. We're still getting strong offers. I do think multiples have probably tempered somewhat but for well-run companies, there's still a lot of demand from buyers. So I think those are the positives. I think buyers have gotten more educated too. Buyers are asking a lot more questions these days pre IOI, when before submitting an initial offer effectively. And I think a lot of that's being driven by their lenders. The lenders are asking them a lot more questions, so they're coming to us with a lot more questions. So interest is still out there. It's just taking a little longer.
Kevin, I want to interject real quick. We saw that pandemic resistance in our business too, from revenue cycle standpoint. Facilities were busy with admissions during the pandemic, whereas the other divisions within Coronis Health were, no one was going to the doctor, no one's having surgery, no one's doing tests for lab pathology. It tailed off, and we were really busy.
Yeah, us too, and you can see that it just in the trends here with 2021 and 2022 really high. If you look at the Q1, it really is kind of reverted back to 2019. So not a bad quarter, but people just got so used to so many deals getting done. So if you kind of moving over to addiction treatment, I mean the 4 deals here, we haven't seen that few addiction deals in a long time, and I think there's a few reasons for that too. Peter, who's on the panel today, when Peter was at Baymark, we've sold him 3 companies over the years. Baymark put a pause on buying anything in Q1. And so they were a pretty acquisitive buyer that all of a sudden, decided they needed, for one reason or another, maybe need to digest some of those acquisitions they made over the last couple of years, et cetera. And so I think there's some buyers that put pauses on things for different reasons. I think, as I mentioned, we have 2 deals that were supposed to close in Q1, 2 substance abuse deals. One, the buyer, initial lender, who's a very credible buyer, basically backed out at the last minute. So they had to get a new buyer. So, that deal is now supposed to close here in about 10 days. But it added, 90 days to our process, unfortunately. So we have another one. This is a large strategic buyer that's been very acquisitive in the space that, they've had some challenges being able to increase their line of credit. And it's a couple $100 million line of credit. So, that deal was supposed to happen in Q1 and now it's, probably Q3 at this point. So there's things like that I think are artificially making some of these deals low. And I think the other thing in the addiction space specifically, there's a lot of groups that have come out of the skilled nursing space that don't like press. They don't like deals getting released. One of the 4 deals that's on our thing, we sold to a group that had come out of the skilled nursing space, and it was a decent sized deal. It was a couple 100 beds in a few different states, but they didn't want to announce it, and neither did the seller. So we never made it public that deal was done. And so I know there's a lot of other deals like that going on that aren't getting announced. So we maybe hop to the next slide, Tracy, please. The mental health space is still really busy. It's down a little bit from 2022, but if you look at where it was in 2019, it's wildly different. So that's still a very strong space. Multiples are still very strong. You double digits in many cases, depending on the size of the business. Generally, lots of interest from buyers. So still very bullish on the and I really, this is mostly outpatient mental health, not as much inpatient transactions. So still lots of buyers that are trying to get in that space. And that market was really created by a couple companies. One's LifeStance and one's Refresh Mental Health. Both were started in 2016, 2017. LifeStance sold for $1.2 billion in 2020 and Refresh for about $800 million in 2020 as well. LifeStance has since gone public. Initial market cap was about $7 billion. Now it's about $3 billion. And Refresh is owned by United Behavioral Health. They were bought in 2020 for an undisclosed sum, but it was it had to be a good deal because they traded fairly quickly after So I think those groups, their success, private equity has seen that, and so there's a little bit of a land grab in the outpatient mental health space at the moment. And then, IDD and autism are down, pretty materially as well. There's been some larger players in that space that have card, most notably, I think exited 10 states, if I recall exactly. There's been some layoffs from some other strategic buyers. So I think that buyers have kind of hit pause on that. I did mention earlier that, we have a pretty decent size ABA company out to market that we got really good interest for. So I think that one will come back, albeit maybe a little bit slower, but I think that we'll start to see some more deals again towards the end of the year. And I think I maybe took up a little bit more of my allotted time, so I will pass the baton. Tracy.
I wanted to introduce next Peter Thiessen, who, as Kevin mentioned, comes most recently from Baymark. And just a little quick backstory. I didn't know Peter at the time, but he was involved in the transaction of a former client of mine, Mount Sinai Wellness. And just to backtrack a few more years, I met Kevin when Reliable Solutions was sold to Coronis Health right before the pandemic, March 2020. So that's when we got to know each other. Just a little background there. Peter.
Sure. Thank you, Tracy. So I will start with sort of some of the things that buyers are looking for, and at least based on my background, not only at Baymark, but at Humana and also at Horizon Health, as you prepare to possibly sell your company, sort of what are buyers looking for? First one, payer mix. That it can be somewhat dependent on the type of program that you may have, whether it's Medicaid based, and in that case, it might be 100% or 90% Medicaid patients. But if not, then a good mix of maybe in-network, some out-of-network contracts, and patients to go along with that. Depending on whether it's substance abuse or maybe mental health outpatient and so on. For example, on the addiction side, tend to prefer more in-network, so greater than 50%, not as critical in some of the other areas, but that's something that's 100% cash based or maybe 100% out of network on the addiction side, not as attractive sometimes. And again, it's dependent on the buyers. Financials. Really like to see a couple of years, preferably 3, and for a couple of reasons. One, like to get a sense of the historical sort of revenue flow for the company or the program. Be able to identify seasonality if that's something. It tends to be something that we see a lot in residential treatment centers, whether it's addiction or otherwise. And so if you have only 1 year or maybe even 2 years, you don't really get a sense of what months or what seasons things are ebbing or flowing. And then just overall, I mean, you'll get some decline in census possibly due to seasonality, but in general, you really would like to see that steadily increasing over time. It doesn't have to even necessarily be a lot, where it really becomes something that buyers will really be either concerned about or will have a lot of questions if we're seeing a steady decline. So if, for example, just use an example, if you had 100 patients on average monthly census 3 years ago, and now it's at 85, there's going to be a lot of questions about why that's the case. Is it something to do with the program itself, reputation, or is it overall industry decline, and so on? So just kind of be aware of that, and we can certainly talk about that in more detail if needed during the process. But that's just something that buyers are going to be concerned about. And so when Kevin and I do this all the time, but when preparing financials and you're preparing an EBITDA projection or even actuals, there's always a lot of adjustments that, or not always, but quite frequently, a lot of adjustments or add backs to that, i.e., for example, interest and depreciation. But there's also quite often maybe personal travel. There are some staff members that maybe aren't going to be staying going forward and don't have to be replaced. And as long as there's reasonable explanations for those adjustments, they tend to be accepted. But there's also, that's usually a spot too that might be open to negotiation going forward. And just be prepared for that. Sometimes there's add backs that maybe don't make as much sense, or synergies that the buyer wants to incorporate that they may not feel like the seller should get the benefit of that synergy, for example. The other one is operating margins, and this tends to fall maybe a little bit more focus related to the strategic buyers as finance buyers, but regardless, and finance buyers are going to do a lot of research ahead of time, but certainly the strategic really will know that business really well, and they'll have a really good idea of where margins are for a specific business type, i.e. addiction, or whether it's outpatient mental health. And so anything that's outside of that by a significant deviation, they're going to have questions about and wonder why that's the case. So for example, if they expect 30% margins and your business is coming in at 45, they're going to want to know why. Or if it's coming in at 20, again, a lot of questions around that. And sometimes that has to do with staffing vacancies and staffing costs. It can sometimes be regional. And so we'll look at that very closely.
And sometimes just to add on that real quick, I think there are sometimes very good reasons why our operating margins may be better. Maybe you're doing a better job of managing the business than maybe a large strategic buyer. And so sometimes there are good reasons, but there are also times where it makes buyers a little nervous if you've got a certain payer that's paying much higher than kind of industry norms. And so they worry about like the sustainability of that. And so, not necessarily a bad thing if you got too high margins, but it's just something that you may need to have to defend as to why. Sure.
Yeah. Great. Thank you, Kevin. Thank you, Tracy. This question comes up, this concern question comes up from both the seller and the buyer on almost every deal, and that has to do with staff retention post-close. Sellers tend to sometimes worry about, well, what's going to happen to my staff? I don't want to see them leave, and we want commitments that you're going to keep X amount of people. And on the buyer side, it's interesting we're worried about employees leaving and leaving very shortly after close, and that can cause a lot of disruption in the business, and really trying to avoid that. And so the buyers are always saying, well, we want to keep everybody or as many people as possible. We don't want them to leave. And because if you think about it, if there's staff disruption, then that typically will translate into patient disruption, and nobody wants that. And so just know that buyers have the same concerns maybe that you do on the employee side, in that they want to keep as many employees as possible post close. In general, throughout the entire process, once the initial sort of purchase price or valuation has been determined, the buyer is really trying to manage risk of essentially everything else that can happen to a deal or happen to an acquisition post-close. Are there any legal issues that may come up? Were there any past legal issues that have to be discussed and possibly be evaluated? What were payer audits like historically? Were there significant clawbacks? Should we expect some going forward? A lot of that we determine during due diligence, but sometimes if an audit hasn't happened yet, and we saw this sort of during COVID, was some of these payer audits didn't happen, or state audits, because they weren't able to get inside the facilities, and there was a little bit of catch up related to that. And then somewhat related to that is indemnifications. Who's responsible for what post close? as it relates to possible legal issues and also payer audits and that type of thing. And then lastly, but importantly, is transition agreements for the owners. Buyers really like to see at least some period of time where the owner is going to stay on board. A number of things. It helps with overall stability of staffing and patient engagement and in many cases development. Usually the owners are very, very involved, and the longer the buyer can keep the owner involved, usually that's more preferable. And I think Kevin's got a lot to add to this too, because he sees this sometimes owners, they want out immediately. That tends to I certainly appreciate why that might be the case, but buyers really like to see that the owner is going to stick around for at least some period of time, and that can be 6 months, a year, 2 years, whatever everyone's comfortable with.
Yeah, I think every single one of these issues, Peter and I did 3 deals together when he was at Baymark, and every single one of these issues we I don't want to say argued about, but let's call it debate maybe. And so that's always one of the first questions we get from people is, how long is the buyer going to want me to stay? And it does vary, but certainly, and depending on the business, I think that if you've done a good job of kind of getting that second level of management in, it makes it easier for you to step away. But Peter's right that buyers always, I shouldn't say always, but generally like the owner to stick around for some period of time, and generally the longer the better, depending on the buyer.
Yeah, and Kevin's right. If you've got a really good sort of senior management team that really runs the business, and in fact, if you've stepped away more frequently in the past, maybe let's say a year or so, then yeah, that transition time period can be shorter, and that certainly helps.
Very good. All right, I'd like to share from a revenue cycle standpoint, what I'm seeing in the industry, and just to put this a little bit in perspective, Coronis Health, Behavioral Health Division is managing currently about 90 customers across 35 states. And we have a mixture of Medicaid and in-network and out-of-network, and really all levels of care in the behavioral health space. The first area I wanted to touch on is verification of benefits. This year in particular, we're starting to see, although deductibles are flat to last year, the hold times for doing a live verification have become almost unbearable. What we're seeing is a shift to benefit reps moving to an offshore landscape, and calls drop. The infrastructure isn't as good. It's very frustrating when you've been on hold for an hour and then the call drops. Just trying to get the benefits, which is a critical piece to behavioral health, because so often substance use and mental health are carve-outs. Employer decides we're not going to cover this as a benefit. And you got to check that, because my customers make a decision to admit a patient based on this live, benefits call that we make. That can really hurt everyone, us and them, if we got that wrong and the benefits are misquoted. So really important piece of the business to pay attention to. Excuse me. We've also seen, and Peter mentioned this as an important component to selling your business, there's a huge shift to securing an in-network contract. And I've had many clients who were 100% out of network. Now, hey, I want to get in network with everybody. And, I just want you to know that the rates are negotiable. It does give you a faster payment cycle. And another benefit to it, although you're going to see probably a third less of what you'd get paid out of network, you get a network provider rep, you've got someone to go to for questions. If your claims are hung up, if you need a project done, you can reach out to somebody, whereas out of network, it's a little bit like the Wild Wild West. There's no one to call. There's no one to give you information. It becomes much more challenging. An example of this is this preferred status, using this as an example that United Healthcare is coming out with in August, their platinum program, where they're going to reward effective and efficient facilities. Now, how they define that is laid out, but it'd be interesting to see how that pans out for, we'll obviously see our customers who are in network with United, but I think we're going to see more and more of that in the future. And as Kevin showed in his slides, this a more prevalence in the mental health space in terms of transactions from an M&A standpoint, we see that as well. We have more outpatient mental health, IOP outpatient programs, mental health is a primary diagnosis, and many of my substance use facilities are adding a mental health track. And so they're treating dual diagnosis patients now. And we, I get it. I think the pandemic is reflected in the increase in the need for this, which I think is, a good thing. And then finally, Peter, you mentioned this as an important component to looking at a business to sell and the payer mix. And I just want to share this last point in a slide. This is my business over the past 4 years. And, I have gone from 88% of our claims being out of network to 12% of my claims being out of network in a short period of time, 4 years. Medicaid has become very prominent in my mix, and government, Medicaid and Medicare, and more customers have made that shift to the in-network contract model. Sometimes customers choose just to get in network with Blue Cross Blue Shield in their state so they can eliminate the horrible paid to patient scenario that you have to suffer with when you're out of network. And for that reason alone, I think it makes a lot of sense to get in network with your Anthem, your Highmark, your Blue Cross Blue Shield. But I do think this is quite a shocking slide. If you just look at total transactions, number of claims paid, I've gone from 125,000 in 2019 to triple that in 2022. The claim volume with these, which is an increase in the Medicaid side, is significantly grown. And excuse me, finally, what I wanted to just highlight, both Kevin and Peter highlighted the importance of reporting, quality of reporting, and the integrity of the reporting. And my team got 2 financial analysts on staff who understand, the business very well. And they've been through a couple transactions with Kevin, and they understand what is required from a reporting standpoint. So we're very good at slicing and dicing the data however you want it. We can provide it.
So I will tell you that if you ask me, one of our biggest pain points in deals sometimes can be, especially if there's any out of network revenue, is getting good billing data. And so people don't realize that we obviously, need the financials out of QuickBooks or whatever financial system you use, but very quickly as we're getting into the process, we'll need all the billing data generally for the last 2.5 or 3.5 years. And it's by line item, by claim. So these spreadsheets can get to be hundreds of thousands of line items long. And so it is so critical to have good data, and ideally, from one provider. We've seen sometimes some of these third-party providers don't do a good job of giving their customers the raw data that you'll really need to sell, because a buyer is going to spend a couple $100,000 with accounting firm to basically crawl through all of your data. And the biggest piece of that is going to be the billing piece, because they're going to recreate the financials on their own. to make sure that, you know, what they're buying is what they think they're buying, or what they're getting is what they think they're getting. And I can tell you, you know, just giving Tracy a little bit of a plug here is, and we worked together because we helped her sell Reliabil to Coronis back in the day, but then shortly thereafter we sold Mount Sinai to Peter, and they were hugely instrumental in helping us get through that process with providing us all the reporting and whatnot. So, you know, I wouldn't overlook this piece, because it is critical to getting through any kind of deal. I don't care whether it's mental health, substance abuse, eating disorder, autism, whatever. You need to have good RCM data and practices.
I would agree. This was one area where we really, or Baymark struggled, not Baymark itself, but the seller had maybe a very small revenue cycle management company doing this type of work, and they were unable to get the type of data that we needed to be able to do get the analysis and do a proper quality of earnings. And you know, eventually the transaction got completed, but it just took so much longer to get there. It is unfortunately a bit of a painful process, and not having good data. And if you've switched companies, maybe, you know, billing companies in the middle in the last couple of years, makes it even more difficult. You have to go back and get data from the previous biller, and to be, you know, hopefully be consistent in there would be is also very helpful.
Hey, and I guess one other just quick point on this is, even if the deal gets done, you know, Peter said that one did get done, but sometimes it may be at a lower price because you don't have good data and you can't prove what you think. So.
All right, well, with that, Risa is going to help us field any questions you may have. I see in the Q&A there's some.
Yes, absolutely. So
Hit us up.
thank you guys so much. So we're going to take this screen down. So if anyone wants to take a screenshot first with these emails, please do. Otherwise, I can pop them in on the chat, but then we're going to stop the sharing so you can see them better. I can do it. All right. So we do have some great questions coming, and this is the time, anyone, to pop into the Q&A, any questions you might have for any of our speakers. So first up, with mental health, IDD, autism, are you seeing PEG acquiring to expand into adjacent services, or simply staying with core services?
So, I mean, I guess I can take that first, but so it really depends. I mean, you know, private equity, for those that don't know what a PEG is, they're doing a number of things. I mean, most of the time they're trying to expand geographically, maybe adding different states, and most of the strategic buyers that are buying are backed by private equity. So, you know, really almost all of the activity is either private equity backed, or there's a couple public companies that do some stuff too. But yeah, a lot of times they will buy, mostly I would say to expand geographically. Although, you know, Baymark back in the day, they were typically an OTP, which is outpatient substance abuse. And in 2020, they decided to get into the inpatient facility. So sometimes they will try and expand the service line as well, but that's really is very buyer dependent. It's hard to say there's any particular trend in that. So.
Okay, thank you. All right, here's another one. The possible percentages of buyers who will want owner to stay on board after the sale versus buyers who are okay with the owner exiting after the sale, and if there are any pros and cons of each.
Peter, you want to start that one, then I can add to it?
Yeah, certainly. I would say the percentage of buyers that want some sort of a transition agreement or a transition period with the seller is going to be 95% plus. I've not done a transaction where we didn't have the buyer available to us, or sorry, the seller available to us for some period of time. Quite frequently, at least in my experience, it was you know, maybe 3 months, 6 months, and it also quite frequently within that, we didn't necessarily expect the seller to be on site. We just wanted them to be available. Maybe if they could come in a few times during that transition period, but it is very deal specific. So sometimes depending on whether there's a good management team left behind, then there's less reliance on the seller. But if the seller is then it takes a bit longer, and again, 3-6 months, possibly a year, depending on the business itself. But I would say in 95% of the cases, we want the seller, at least for some period of time.
So I think, I do agree with Peter that most buyers are going to want, I've seen anywhere from 30 days. Like when we sold our company, we had about 200 employees. The buyer was a public company, only wanted us to stick around for 30 days, which frankly, I was fine with because I wanted to leave, but I don't think it was a very smart thing on their part to do that, because the business did decline after we left. And then we've seen it where people, stick on, they're rolling, 20-30% equity and want to stick around until the private equity group sells it to somebody else. And so we do see, I will say that the biggest thing is if you can tell us or whoever you work with what your expectations are early, then we can try and position that with buyers. Like we have one right now where the owner it's a good sized company, he's making $4 or $5 million a year. He works 10 or 15 hours a week. He's got a great team in place, and he's been very clear. He does not want to stick around long after the sale. And he's made that, we've made it abundantly clear to the buyers, and so is he. And so I think in a situation like that, it's much easier because he's put the people and processes in place that will allow him to do it. But I think the biggest thing is just setting expectations on what you want to do post-closing.
Yeah, I would agree. I mean, this is something that always gets negotiated and it always gets worked out. Is if the seller really doesn't want to spend a lot of time, there's a way to figure that out. As Kevin just mentioned, maybe 15 hours a week or so. Many of the deals that I looked at, it might be 30-40 hours a month, and for the first 3 or 4 months, and then transitioning. And quite frequently, to be honest, we probably didn't even use the seller for 40 hours a month. But having that person available to deal with usually it's something related to staffing, and maybe a contract negotiation or something. But in general, it's we're always able to work it out.
Understood. Okay, we're getting a lot of questions coming in. We have 15 minutes left. We'll get to as many as we can. All right. This is actually a good one for Tracy. So do insurance companies pay more for a mental health claim than a substance abuse claim?
We've seen parity in payment. No, we don't see a difference.
Okay.
There are exceptions
Mhm.
on the policy, but on average, no difference.
And as a follow-up, are you seeing any better in-network rates for detox, residential, PHPs, IOPs in Texas or in SUD treatments?
Gosh, if you had an eating disorder program, you're going to be able to negotiate some really good rates. And then it's going to depend on geography. So LA County, for example, is going to be able to negotiate a higher rate than a facility in Arkansas. It's just all based on cost of living index. So it does depend on where your facility is based, what region, and then behavioral health, that eating disorder, and then a program that also is treating that adolescent population. They're very much in high demand. So you have an opportunity there.
Got it. All right, here's a good question. Multipliers seem to have come down lately. Do you foresee a swing back to the increased multipliers at any point down the road?
I think it's different for, say, addiction versus mental health versus autism versus eating disorder. They're all, even they're all behavioral health. They're all fairly distinct in the multiples. So, look, I think multiples are tempering, and I think the addiction side, they probably come down maybe a turn or so. I think the peak, frankly, for addiction was probably in 2017, when some of the multiples were kind of in the mid-teens and whatnot. I don't know that we're going to see some of that again and these are for what I'm calling, smaller companies, say sub 50 million in enterprise value. You get bigger than that, then the multiples can be, mid-teens, upper, or the 20s, just depending on the size. So there's been some big deals there. So I think substance abuse has come down a little bit, and a lot of it depends on, the biggest thing in substance abuse is really your payer mix and the size. So if you're all out of network, you're making a ton of money, which is great, but it makes it much harder to sell. And if so, the multiple is going to be lower than if it's in network. And in many cases, it may not make sense to go in network just for the sale, because you're making so much more money out of network. So, I'm always hesitant to tell people that you should go back in just to sell, because it might be better to keep the business and just keep making that money. And I noticed on one of Tracy's slides, the average rate for out of network went up like $200 since she started keeping the stat. So you may be better, multiples on outpatient mental health. Those are probably the strongest right now. They can be double digits for, somebody's a couple $1 million in EBITDA, but even for smaller ones, they can still be 7-8 times. So it's so dependent on each individual business. We're always happy to do valuations. We don't charge for it, and we can, look at your specific scenario. It's really the best way, because they're all over the board. It's one of the reasons I actually like behavioral health. It's every day is a little different. You never know.
Great answer. So how successful are deals for 100% out of network cash only mental health practices, and what would make those deals successful?
So mental health's a little bit different than if that were substance abuse, it'd be really difficult to sell. You could sell it, but the multiple is going to be 5-6 times probably. On the outpatient mental health, we're selling one right now in the double digits. That's all private pay. So, I kind of put private pay and out of network in somewhat similar bucket, because the reimbursement's the same. So, but it does make it more difficult, smaller buyer universe.
So, are you seeing reimbursement rates from out of network third-party payers decreasing across the board for all levels of care and SUD treatments?
No, actually, that slide I had up earlier showed it actually is increasing. So we're seeing out of network average reimbursement increasing. I'm not saying it's any easier to get paid, though. It's still a fight, but we're seeing it go up.
Which is fascinating, because, the buyers have been scared about out of network for about 5 years at this point. Yet here we are, people are getting $200 more, or whatever that number was. It was material. Yeah. So interesting.
Mm-hmm. And again, I have customers all over the country. So, that's a mixture of your California and your New Jersey and your Kansas, wherever, right? Texas, everybody.
So do you think there's currently a good level of interest for larger, well-established cash pay outpatient psychiatric practices?
Yeah, I think, especially psychiatric practices are in high demand right now. So yeah, I think that would still be very attractive. It depends on, the size, of course. If it's more than $1 million in EBITDA, then it would be very attractive. But even if it's a little less, there's still buyers out there too.
Got it. And is it common for a buyer to pay according to how many staff stay on after the sale? And can there be a consequence if some of the staff does not stay?
So we've seen, and I'm guessing this is probably an outpatient mental health company. There's a particular buyer in the market that is doing that, where they're requiring some sort of earnout or contingency payment if 90% of the staff needs to stay or 80% of the staff needs to stay. I personally don't like that. I generally don't like earnouts. But we've seen that from one particular buyer. We've never sold them a company, but anyway, so it's not common, but I've seen it.
Got it. And when acquired by PEG, can you talk about the ramifications of what occurred to the acquired company when PEG sells 3 to 5 years later?
Well, that's probably a webinar that we could do another hour or two on, but the long and the short is the private equity groups are often selling that second bite of the apple, where they'll say, hey, look, let me buy 80% of the company today and we'll pay you $10 million. You roll 20%. And in 3 to 5 years, that 20% could be worth $20 million. So it could be worth more than, it could also be worth zero. So, you really need to do your homework on the PEG there and see, what their track record looks like, talk to some of the people that have done exits with them in the past. Because all private equity, like everything, is not created equal. There's some really good ones that have really successful track records and others that are, So, but that's a much longer discussion, but that's kind of a quick answer.
Okay. Okay, guys, we are coming to the end. Couple last questions. So what if the seller wants to stay longer or potentially be part of the executive team?
So private equity, if they don't already have a platform in the space, and even if they do, they generally would welcome that with open arms. They love for, and frankly, it makes Peter and my job much easier. One of the biggest things is people always want to, sell their company and throw the keys over their shoulder and hit the road. So if we get somebody that wants to stay, it's just, makes it much easier sale process.
Got it. All right. So 2 more questions. We have tried getting in-network contracts, but continue to be told the panel is full in our region. Any suggestions for getting in-network with some of the payers?
It always helps when you are submitting a request for information, hey, is the panel open in your region? If it also is accompanied with a letter of intent. And so you're explaining to them, hey, here's why, I want to go in network. Here's why my program's different. You got to pitch it. And so that helps a little bit. Persistence helps because they still may say, no, I'm sorry, the panel is closed, but check back, next year. You do have to keep checking back. And I mentioned this earlier, that if you're treating adolescents, that the 13 to 17 population, it's very much in high demand. So you pretty much have a ticket to get in network and eating disorder as well, because it's in high demand. And that wouldn't be a problem for you wherever you're located to get in network. So your program helps that you're providing the population you're serving.
That's helpful. All right. And last question, I think probably for you, Kevin. So big question is, what is the market looking for at the moment? And the more specific question is, at the moment, would a fully integrated care practice with all in-network payers, credentialed both medical and behavioral on all lines of business, with OTP services, be at the forefront of what people are looking for?
It's tough to, say yes. I mean, OTP space is a little bit soft right now. Baymark was a big example of that. They're really not buying much or anything at the moment. And there's some other big OTPs that aren't buying a ton, but I think having kind of that fully integrated model certainly makes you more attractive. And depending on your size, you may still be big enough to be a platform to private equity. So it's kind of hard to answer that question without knowing more. So if you want to reach out directly, happy to have more of a detailed conversation. But I think, if just going back, outpatient mental health, still very interesting. Eating disorder, still a huge need for those. There's a lot less of those. So eating disorders are very attractive to investors now. I think autism, ABA companies, still interesting, but I think that market will pick up at the end of the year. And then substance abuse, it's softened a bit, but I still think there's, and the buyers have changed, but there's always a good need for well-run companies. Mm-hmm. It's the ones that are maybe on the margin that are a little tougher in tougher times. Yep. So.
Understood. All right. Well, that time flew by. A ton of great information shared. I think we got a lot of questions answered. I want to thank everyone that came to attend and join. And of course, our 3 esteemed speakers, Kevin, Peter, and Tracy. Thank you so much for your time and expertise today. I Did share in the chat everyone's email addresses, because a lot of your questions I think may require, you know, some personal one-on-one consultation. And as a reminder, we will be sending out the recording, and I'll include everyone's contact information in an email so everyone can reach out. But, you know, I hope everyone now is a little bit more aware of, you know, MERS and Tagger as a potential, you know, consultant to help you at the sales process, and Coronis Health and Tracy, if you want to increase that EBITDA a little bit and get your numbers up before you start talking to Kevin. So you can hit that.
That's definitely a good
$1 million.
thing.
Yeah.
So
Thank
it's
you.
kind of a good combination right here.
Thank you,
you.
Risa.
Any
Thanks,
final
everybody.
words from any of our speakers?
Have a good weekend.
Thank
Yeah,
you.
thank you.
Yes, have a
Feel
good
free to reach out
weekend.
if we can be helpful.
Thank you guys so much, and good day, everyone.
Thank you.
Okay.
Bye.
Bye-bye.